I'm VanDesande. I was in the first session for those of you that weren't here earlier. I'm a retired criminal senior agent, international out of IRS. Treasury, did work for about 30 years doing that. A partner?
My name is Dan Rashbaum. I'm a criminal defense lawyer, primarily a trial lawyer. My partner, Jeff Nyman, who I'm filling in today, specializes in tax work and offshore work. So I'm going to try my best to fill his shoes.
So this is a real interesting case that we have that we use as a case study that David and I spoke about. It's the case of the Wyly brothers, the two, well, actually one's a billionaire, one was close to being a billionaire out of Texas. They've been in the papers probably for the last 15 years because they started conducting a transaction that ended up being a fraud case. And it went civil, criminal, went to bankruptcy, went back into civil.
Out of curiosity, before you get into it, how many of you are at all familiar with the Wyly brothers? Okay. And how many of you are familiar with either their SEC case or their tax case? Okay. Now, how many of you are just familiar with their SEC case? Very few. Okay. All right. Now we know where we're going.
Now you know where we're going. Just as a quick summary, I'll read you the first couple paragraphs of the SEC complaint. The original complaint came out of the SEC, and it was really well written. It talked about the defendants Sam Wyly and Charles Wyly engaged in a 13-year fraudulent scheme to hold and trade tens of millions of securities of public companies while they were members of the boards of directors of those same companies, without disclosing their ownership and their trading of those securities. The Wyly scheme defrauded investing public by materially misrepresenting the ownership and the trading of that stock. And they were charged with insider trading also. It stated further on that the apparatus of the fraud was an elaborate sham system of trusts and subsidiary companies located in the Alaman and the Cayman Islands. They referred to it as the offshore system. Obviously, the trusts were not fraudulent. The use of the trusts were fraudulent. So common thing that they do in the indictments. It said through these trust agreements that they purported to vest complete discretion and control in the offshore trustees, but in fact they never relinquished control of the securities or the control of the trust. And they ended up going about where they had beneficial owner of over $750 million worth of securities. So the SEC started the violation that way, and it's a really interesting case because it has everything that we do in the offshore world and how to do it wrong. I mean, this is a textbook case. If you read through this, just type in their names, and if you read through this, don't do any of the stuff they're doing.
And the other interesting thing about it that you'll see as we discuss it a little bit today is the conduct here was in the mid-2000s. But what you'll see when you think about the cases of today, like the Panama Papers case and Odebrecht, there's a lot of similarities in some of the things that these guys were doing in trying to disguise their beneficial ownership through these offshore entities. And what you'll see is it's not limited to the tax world. What I think is particularly interesting about this case is how the SEC was actually, in some ways, the instigator of this. Some would say for political purposes, but nonetheless, you'll see how they used these tax havens to actually, allegedly, or I mean, they admitted to it, commit securities fraud. So, Art.
Yeah, excellent. So the goal of their setup of these trusts was obviously to reduce their taxes through tax evasion. But the main goal, like my partner said, was the ability to sell their shares without disclosing the sales to the regulators. And in one particular case, they actually were cited for insider trading. If you know how much you need to order to hide your ownership in shares while you're sitting on the board of directors of a major company, this is very unusual. It happens in small companies, but not usually this size. They established this aggressive strategy using these offshore trusts and companies, and they use some in the United States. They used the companies in the Alaman and the Caymans, and some in, I believe, in Delaware also. They started kind of the flow of the money out. The main issues, they're claiming that it was a non-grantor status, which allowed them to have a no taxation issue. That was their claim to fame in this case. And then they established trusted intermediaries, 2 gentlemen in particular, to control the trust and the companies. So what they did is they transferred their stock options or ownership of stock to these companies, and then the companies transferred the ownership to the trust. So it was just real clear. They owned all this stock from these major companies, some of which they set on the board, and then they transferred that ownership over to the companies, some in the U.S. to start, some in overseas, and then the companies sold it again or put it under the control of the trust overseas. So they did that for a reason, and what they were saying, the basic gist of it was they're saying, I'm giving you my stocks, and what you're going to get back to me is a private annuity. So it wasn't, I'm selling it, you're going to give me back cash. It's the reason why I'm giving it to you is because you're going to return it to me in a private annuity every year. So they're basically drawing annuities from all these different trusts, sometimes tens of millions from each one, every year consistently for over a decade, and claiming them to be an annuity, tax exempt, because they didn't have any control over the trust. In reality, of course, they had control over the trust. One's a billionaire and the other one, they're both aggressive traders. They knew the law, they knew all the rules. So they did that, and then what they did is they even acquired additional shares and options through private placement. So after the trust started owning the stock options, then they turned around and went back to the companies that they ran and asked for advanced private placements, which means they got the benefit of a special deal. And then those they sold back, they bought them and they sold them to the trust companies. So under the guise of this secret shroud, they also took advantage of advanced placements. Now, who gets an advanced placement if you're not an inside person in the company or a favored company as it relates to the person selling the shares?
This was all very, very important to both the court that decided the SEC case as well as the tax case, because what the court determined is that they put together this complex structure that had really no purpose. The only purpose that it had was to hide their own beneficial ownership. So the court made a determination that by doing so, that was in effect an acknowledgement that they knew what they were doing and that their intent was to do precisely what they were doing, which was to create a way to basically commit securities fraud and tax fraud. And we'll talk about some of the lessons learned, but that's something to keep in the back of your head if you're either setting up these offshore entities or if you are planning, whether it be estate planning or whether it be tax planning. It's important that what you set up actually makes sense for a legitimate purpose, because that was, in the end, especially in the tax case, their undoing, is that their lawyers could not, with a straight face, give the court any real tangible idea of what the legitimate purpose was for setting up this structure.
They used 2 individuals mainly. One was the 2 intermediaries. One was an attorney, one was a stockbroker. That's all you need to make these processes work. One attorney and somebody with a securities license. Yeah. So the one gentleman was the registered agent, and he was signed on as the protector over the Isle of Man Trust. That's somebody who's in a responsible position, but not the person who's ultimately supposed to be controlling it, which should be the trustee. And then the second person was the U.S. side, the securities guy who can execute all their trades for them, and he was the person on all the bank accounts and the financial investment accounts. So they had it wrapped up real nice with 2 people, and you can see the weakness of that coming up because, the government's going to go after those 2 people. In addition, while they had these trusts set up, then they started buying artwork, ranches, all types of properties, and they allowed the annuity receivers to use the property at will, live in the houses, enjoy the artwork. So you can see that this was not even a great plan for someone so smart. And then it started to unravel because the stockbroker originally moved from Lehman Brothers to Bank of America. And at that time, Bank of America, being a large company, this starting with the KYC rules, they initially asked the stockbroker, can you provide us some more information on the beneficial owner of these trusts? that I see all the money moving around. So we need a little bit more information than XYZ Trust out of the Isle of Man or the Caymans. When they refused the information several times, they ejected the accounts out of Bank of America. So good for them for asking the right questions, not even getting a valid response, and they ejected them. Once they ejected them, the belief is that they filed the SAR, the Suspicious Activity Report, and that got to the SEC, and things started to pick up after that. So just because this gentleman was not able to provide the beneficial owner information, that's how the case got going.
And what happened is, once the case began at the SEC quickly understood that there were tax implications as well. So what you'll see in a lot of these cases, primarily in the area that I deal with, which is criminal defense work, is the one agency will make a referral to another agency. So what happened in this case is the SEC reached out to the tax division of DOJ, and then the case, they basically worked the investigation in parallel. So you had a tax investigation going on at the same time as the SEC investigation. So the government was basically pounding these guys from both sides.
So the first major issue that they had is the issue of the grantor, non-grantor trust. So we all know the basics of that is that in one, you're controlling the trust, and in one, you give up rights to what you're giving to the trust. It's not, I don't think we need to be more complex than that. Sometimes we can spout off a lot of information, but in one, somebody, the grantor gives you the assets, the income, and says, go do great things, and this is what I want done with it. And they lock it in under the agreement, and you have a trustee, beneficiaries, and in some cases, like in the Isle of Man, you have a protector, different classes of persons. So in this case, they said they were a non-grantor trust, and in fact, they had full control over the trust. So anytime you see somebody who's giving direction to the trustee, to the accountants that work for the managing companies that manage the trustees, they give direct advice, there's no discussion, there's no board meetings, there's not, oh, let me come and give you some advice on how to use the trust. It's no, here's an email, here's a fax, buy this stock, sell this stock, buy this property, buy this painting. It's pretty straightforward that you're in charge of that. And if you're dumb enough to set this up like these gentlemen were, and they're not dumb people, but they're dumb enough to do these acts, to actually have that on your email, to have those faxes, hundreds of them, then you're going in the direction that they did, which is a complete and straightforward fraud case. Right off the bat, the issue of taxation is settled because they are the controllers of the trust.
And ultimately, their defenses were very limited. Let's take the SEC case, because they not only had a trail of emails which showed that they were basically using the trust as their own piggy bank, but in addition to that, they had two individuals who were being threatened with criminal prosecution themselves, who could give the government a roadmap to each and every action that the Wyly brothers were taking, and they obviously cooperated against the Wyly brothers. So this is another example that you see a lot in my industry, which is you see very wealthy, intelligent folks who think they know better, and think they won't get caught, and so they have hubris. So it's ironic, but in 85, I would say to 90% of the white-collar cases that I deal with, there is usually a roadmap in emails or text messages, and that was certainly the case in this case.
Yeah, so the setting up the trust for my fellow islanders here, no issue with that. I know there's a lot of people that would say there was an issue with the Isle of Man Trust and the Caymans. There's no issue with establishing a valid trust and a valid jurisdiction, paying the right fees, getting the right paperwork done. It's obviously the use of the trust and the companies associated with that are a problem. Now, there were some individuals inside the managing company that knew what was going on. So in reality, the U.S. was probably being nice in this particular case and did not charge those individuals with conspiracy to commit XXX or SEC violations or tax evasion. Maybe they didn't have the right data, maybe the emails weren't strong enough, but any of the individuals in those companies that know they're participating in tax evasion or SEC violations, you could charge them. The U.S. would be glad to charge them, and they'll put them on they never come to the U.S., they'll put them on the Interpol list, and they'll be on a red border letter, and they'll never come here, ever. They'll be Roman Polanski 30 years later. So it's important that the people managing the trust do not step over the bounds, step outside that. And it was funny because in this particular case, they used the same companies that they set up the structures with. They used related companies within those organizations to manage the trust. Normally, when you have somebody using a trust for something bad, they set up the trust with somebody or the company, and then they take it to another company in the same city to do the managing part, which is maybe the bad part. So in this particular case, you saw it together. In fact, the managing people did so well that later on, the billionaire released his people from doing the work and had the local person start doing all the detailed work. So they actually gained trust that they were doing this for so long. So the key in here, of course, is not, it wasn't the jurisdiction of where they were, it wasn't the initial setup, it was the management of the trust that was wrong, because even those trusts knew that they had to file disclosure issues with the SEC for buying and selling securities. If there's one thing you want to get in trouble with overseas, in a foreign country with a trust, is buying and selling U.S. securities. That's like a no-brainer. Anybody who's soliciting securities overseas or selling them, you're in trouble if you're not following the SEC rules. It's just too easy to get hit that way. The next issue was the tax shelter issue. The IRS will allow a lot of tax shelter variations, but none that are strictly evasive like this one. Okay, and if you are going to allow a tax shelter of some sort, we're using it in the broadest term, you have to disclose it, you have to seek independent counsel, you have to get an opinion from a qualified person, you have to have that opinion put out so people can see it, both the government and your attorneys and your CPA and your audit firm, all the above. IRS people, you have any comments on that one? Tax shelters? Dan? Nope. You're out now, you can say things. So, as in any unusual position you take with the government, it better be in writing and it better be by a competent person. One thing the IRS doesn't do, and this goes back decades under the tax shelter policy, is we don't accept a qualified opinion from the person promoting the tax shelter. Okay? So if you go to a conference or an offshore thing where somebody's selling these type of shelters, and they give you a nice brochure and it has all a bunch of legal advice and it looks really cool with colors and very nice that you can hand to your attorney, that's not the person the government wants to see writing the opinion. It needs to be someone other than the promoter of the trust. Kind of an important point when these things come up. So, and in fact, this original trust setup, in the articles they say that the billionaire and his brother, who was almost a billionaire, the billionaire brothers, they actually met with a person named David Tedder, who years ago was involved with many offshore trust promotion schemes, and later was charged and I believe convicted in a crime later on for another type of one, but not this one. And they met together at the billionaire's house, is what the article says, allegedly says, and that's where they possibly got the idea for this process.
And again, you'll see that this is not an isolated incident. Some of you may know about the case of Eric St. Cyr several years ago. There are other cases where these promoters end up basically benefiting from the scheme, giving the idea of the scheme, and then the individuals, when approached by law enforcement, will use a quasi-attorney-client privilege, either using the promoter's advice, because a lot of the promoters are lawyers, or other individuals who they've hired to give them advice, but frankly aren't experts in, tax, aren't experts in securities issues. So it's an imperfect attorney-client defense. It's imperfect, and that's exactly what happened here. So again, there's a lesson to be learned in that case as well, which is if you're going out there and you're trying to create some sort of tax shelter or some sort of advantage, you need to, and you want to protect yourself through the attorney-client privilege and the attorney-client advice, you want to make sure that you're using an independent and qualified person in the area that you're seeking protection from. That was the opposite of what the Wyly brothers did. They used people who were A, conflicted, B, didn't have any experience in these areas, and C, they also got advice from those who did have experience, and guess what they did when those people said you couldn't do it? They ignored it. So that is a lesson to be learned by all in cases like this.
Other than the annuity income that they receive from the trust, which is how they receive majority of their income, tax-free, allegedly, with very few instances it was tax-free according to them, they entered into loan agreements with the trust. So if the trust bought a ranch, they would say, well, I will sign loan documents, okay, so I'll make payments. Okay, you bought it, you own it, trust company in Alaman, but I'm going to use the $20 million ranch in Texas. And they would enter into these trust agreements. Most were, of course, interest only, 15 years out, balloon payments. So they weren't, if you go back to the basic IRS rules of what is a bona fide debt, you go into the law about what is considered a bona fide debt, you would look to see about the fair market value, is it appropriately priced, and are you really making payments? Do you think these guys were making even interest-only payments? And if it was on the books. So they created these big, elaborate loans with 15, 20 different trusts to satisfy their goals of having this property that they didn't buy, that's sitting inside their house. So the artwork, the ranches, the bought property for the kids. So now they did do a disclosure. This started in '92, and this went on until just recently. The IRS just resolved some of it. But in 2002, 10 years later, they filed a disclosure form. But they didn't stop the activity. All they did was file a disclosure form, most people believe, because they thought that if they did get busted, and after they had advice that this was an illegal, possibly illegal scheme or taxable scheme, that then at least they would be able to have some of the penalties, what's the right word, Dan? Abated, reduced, abated, yeah, be a good word. So they started to make disclosures just for the penalty issue. And then, as my partner said, they started to they had some reliance. They started to say they had reliance on counsel. So they said we had subject matter experts come in and check out the scheme, and they gave them advice, some in writing, that this is not a good scheme. It's a taxable scheme. And they still continue to do it. So let's go over some of the things they could have done. You guys work in different fields, so there's an easy way. They could have just moved assets. Now, they weren't going to get the full tax-free ride on some of these schemes, but they were...
Let's back up. They could not have done in any way what they did, right? So the benefits that they got, they could not have gotten in any legal fashion. So let's just be clear on that. However, they could have done certain things that would have given them some benefits from both a tax perspective and possibly even from the securities case perspective. But go ahead, Art.
Yeah. If some individuals have a large amounts of income in the United States, obviously you might want to move it. You can move it to another jurisdiction. You can come up with all type of loan strategies. You can come up with expenses. You can create companies overseas and start slowly moving the money over there. There's all different types of ways that large wealth individuals can hide things and start getting tax advantages through the expensing. Now, most of it would probably be false, but it'd be a lot less onerous than this type of tax scheme. You can invest money from overseas. You can create companies, fund the companies, have those companies then buy and sell the stock. They'll have to do their reporting requirements, but at least you start getting an advantage. You can have movement of some of your funds to family members in lower tax brackets. They had kids, they had grandkids. They could have done the normal variety of estate planning issues to lower some of their stuff. And in some cases, they could even maybe have done the intellectual property issue, the thing that Google does and other companies where they say, I set up a company overseas, and what I buy and sell overseas, I'm putting the profit over there. And then I can repatriate the portion that I want back at a later time. They get a credit for the tax paid over there, and you can be in a lower tax jurisdiction. Most people like Ireland for being the lowest, but there's all types of little scenarios overseas that you can use. If you've heard of the Dutch sandwich with the Irish-Dutch company, there's all types of things like that that you can do. And they do work, and they do lower your taxes. And then if you want to be aggressive and go into the gray area where you're probably starting tax evasion, but still less risky than this, you can start re-invoicing type schemes, transfer pricing, where it's a lot of paperwork moving around and it keeps your money moving so people don't look at it too closely. But you still get a better advantage and less risky advantage than what took place here.
None of those techniques, see, my partner Jeff Nyman and I fought about this a little bit when we discussed this case, because my belief in looking at the case was they didn't do what they did to avoid taxes. That wasn't their primary goal. They did what they did primarily in order to be able to commit securities fraud, right? So what they wanted to do is they wanted the ability to do insider trading, and they wanted the ability to not disclose certain information in their regs that the SEC requires. So in this case, it wasn't really a scheme driven by tax implications. It was a scheme driven by an effort to basically make more money on the securities.
Yeah, they actually...
There's a question over there, I think.
At any time. Yeah. Bogus. Also in corporations that are but corporations overseas, if you see any document similar to that where it allows somebody to override the leadership immediately, it's probably a fraudulent setup. So I know in Panama they used to set up a corporation, a foundation, and a trust. They have a nice layer, and then what they would do is they would hide the beneficial owner, and then to the beneficial owner they would give them a piece of paper, and the piece of paper would have a signature of all the directors of the companies, and it was a revocation document. So at any time the beneficial owner wanted to release all three of those companies, they could go down to the registrar's office. They already had the owners of each of those companies' names signed in blue ink. They turn it into the registrar's office, and it revocates the ownership of those individuals. Now the scam there, of course, is that's not the bank account. So you get your companies back doesn't mean you're going to get your money back. And that was the other half of those scams. So yeah, in the SEC it says that they were able to sell, without disclosing beneficial ownership, $750 million worth of securities. That's what the real scheme was in this case. And later on in the same charging document, it talks about they were able to, in block trades alone, sell more than 14 million shares, realizing a gain at least in excess of $550 million. So that's
where they made their money.
Yeah, better than...
They didn't make their money in saving taxes. They made their money in the $500+ million they got from their securities fraud.
Exactly. Correct. It was like 190 million disgorgement.
That's true to some degree, but remember they committed insider trading that they would have never been able to commit in the first place. had they not disguised their beneficial ownership in the companies.
Yeah.
So in other words, they never would have made the profit to begin with to cause the tax savings had they not been able to commit the insider trading that was able to be done because of the mechanism that they set up.
Good point. The tax savings as a result of the SEC issues, very valid. There's you saw in the later opinions, they wrote about it extensively. A very valid point. But these guys were manipulating a lot of stock sales between their related companies. They had, I think, 4 large ones running at the same time. And the ability for them to trade without people knowing that the owners were buying and selling stock, especially the advanced placement, which is very odd to see. You know, normally institutions get the advanced placement because they're large customers. So these guys were getting a trust with no connection to the billionaires to get an advanced placement.
Yeah, they were there to avoid the market rights.
Yes. Yeah.
That's often the case. So what you'll see in securities cases all the time, which is one of my primary fields as opposed to Jeff, who's a tax field, is when they're trying to measure damages. How do you measure the damages? How do you measure the restitution? How do you measure the harm to investors? And often they'll go with the computation of tax, right? It's a little bit of the chicken and egg argument that we're having right now. What was their primary goal, or what came first, right? The reality was these were individuals who were certainly greedy and wanted it all from a tax consequence. You'll get no debate from me on that. But knowing the case as I know it, knowing the lawyers who defended the case as I know them, I think they would tell you that their primary impetus when they started it was, yeah, they knew there would be tax savings, but they really wanted the tax savings off of the securities gains that they were going to get that they couldn't get otherwise. If they had not set up this structure, they would not have been able to make those transactions the way they did. Nonetheless, they got tax savings too. And the tax savings ended up being, to some degree, their downfall, right? Because, as I said, the tax court was very clear, much more so than the court in the securities case, that when they looked behind the curtain and they saw what the actual structure looked like, it made no sense. It had no legitimate purpose other than as a illegitimate tax saving, or from the securities perspective, a way to hide what they were doing.
On there, yes.
Well, so the short answer is yes, and sometimes look. That's the first question you're going to ask as a defense lawyer when you know your client is being investigated. You're going to want to know: is it a criminal investigation? Is it a civil investigation? Are they a target, subject, or a witness? You're going to want to know that. But the other thing that you're going to know is, remember the securities case here. The lawyers were aware of the securities case before they were aware of the tax case, in this case, in the Wyly case. Now, having said that, the minute you know that the SEC is involved in a case like this, the first 2 things you're thinking of as a defense lawyer, well, the first thing you're thinking of is not IRS, you're thinking Department of Justice, the criminal division. That's the first thing you're thinking of. And the second thing you're thinking of is the tax division. Okay, it just goes hand in hand. So you know that if you have an issue on a securities case and your client has committed securities fraud allegedly, they're going to have tax issues as well. It just always follows. And you know that even though the SEC is a civil litigation, you know that they're in very close contact with the local U.S. Attorney's Office as well as the Fraud Division of the Department of Justice, and you know that the Department of Justice is lurking right behind it. So I would also tell you that probably the reason why the case settled the way it settled is with an understanding that the case would ultimately go that direction.
Yeah, strange thing about the investigation, sir, is that they did the SEC case, then of course they initiated bankruptcy proceedings, so that got, there's just lawyers on top of lawyers, and there's hearings, and this thing is out of control. As a former agent, you would think, okay, this is going to end up in IRS criminal investigation. Charged with tax evasion or money laundering, wire fraud, mail fraud. There's all types of things going on here. But at this level, with so many years in the case and so complex, a lot of times criminal will just stay out of it, and they'll allow civil and SEC to handle it, or bankruptcy, because it's too much, it's too many people, and there's too many resource hours already used on it.
But it is amazing, right? If you ask, I have not done this, but I'm going to guess. If you ask their lawyers whether this case had a successful outcome for them, their answer would be yes, right? Because there have been many more. Now, lawyers always like to take credit even when we lose. But having said that, there have been many criminal securities cases and criminal tax cases with much less evidence of intent and much smaller schemes than this one. But yet they were able to keep this case out of the criminal arena, and I'm not 100% sure how.
I knew you were going to go there, Jack.
But when you read the commentary on it, some say that the reason, look, the SEC is not that aggressive. They've gotten more aggressive recently. But in this time, they were not doing so well. Let's just put it to you that way, right? And Madoff had, remember, this is the time when the SEC had missed Madoff, right? And some say that the SEC went so hard against these guys precisely for that reason, right? Is that it was a political witch hunt of the other direction, that they were the guys who were the Republicans, and now you had a Democratic administration. Remember, when they were prosecuted, Obama was the president, right? So again, and having been a former federal prosecutor, I will tell you this. If this had been my jurisdiction, when I was a federal prosecutor, I would have chomped at the bit to prosecute these guys, because it is a relatively straightforward case of high profile and high significance. And so it is astounding to me, and it seems like their defense lawyers did a pretty darn good job of keeping it out of that arena.
Yeah, they had two key weak links in this setup. Of course, the brothers would never go against each other.
Well, and one died.
Yeah, well, that happens. Yeah. But usually in family crimes, we as agents, we never say that the family members are going to go against each other. It's a long shot. It's like getting a husband and a wife to go against each other unless they're in divorce. So you usually can't get the family members, and they kept a tight leash on each other. They were close. They had, Sunday lunch every week. They were always with each other. They were always in the same companies together. So you knew you weren't going to have much cooperation there. But the two individuals they used, the attorney and the stockbroker, were in this deep. And as an agent, you could look at that a mile away and say, those two are going to eat this. And those two all made independent statements to stockbrokers, investment houses, banking institutions, trust companies where they claimed that the trusts were independent, and they assuaged everybody's fears that, no, guys, no, that's not related to them. They're independent trusts. They're independent. And so they made all these conspiratorial claims, which would have been easy to roll up as overt acts and a conspiracy charge against them. And that's what they did with Mr. French. And he rolled over to the SEC, which he needed to, because he can't eat that whole charge. And he agreed that they established these networks, that they traded insider trading, they didn't disclose the trades. He was the protector, but they ran it. He only did what they told him to do. I mean, he gave up the whole ship. So this is an easy case for criminal charges. Why they didn't do it? my take is because it's just too many man hours involved over too long of a period. The government wants to just move on, take what they get and run. Oh, good.
I'm sure it was. I'm sure it was. But the question is, in a case like this, even though there might be difficulties in establishing jurisdiction on the securities fraud count, right? What about the other counts? No, but why are we talking about the state? I'm talking about the Fed. Well, that's my question. I was a federal prosecutor. So as a federal prosecutor, I wasn't a federal prosecutor then. I would have been happy to defend them. But here, what I'm saying is there are many federal criminal cases. I mean, look, you look now at what's happening in the cases out there right now. Panama Papers case, you look at these cases. And in some ways, they're a much grayer area than what these fellows are doing. And I can tell you that the feds don't think they have any problems with jurisdiction in those cases. And then remember, the feds have more than a securities violation to take in charge. I'm sure there were wires. I'm sure that there was mail fraud, right? I'm sure that there obviously were tax issues. So there was a boatload of potential issues, and maybe you've got it right. Maybe the politics saved these guys. Whereas, and maybe, I'll give the lawyers credit, maybe the lawyers made the SEC case and the tax case go away in sort of an agreement that it would never get down that criminal path. Because I will tell you, having defended a lot of these cases, when I look at the conduct here, it would be look, in tax cases and securities cases, 9.5 out of 10 times as a criminal defense lawyer, your only defense is defending intent, right? Because ultimately, the securities trades happened, or they didn't happen. Right. The tax savings either happened or they didn't happen. So your defense centers around your client's lack of criminal intent, which the government has the burden to prove. When you look at the facts of this case, that would be a very, very tough defense on these gentlemen if they didn't have criminal intent, right? The whole case was actually built backwards by the SEC. It was built on their intent. So to me, it's a very strong criminal prosecution. And for whatever reason that it wasn't charged is surprising to me. But also, I guess you got to give the lawyers some credit. We don't get credit often, so you got to give them some credit.
It's important that as we go on, and whether you're in regulations or banking or law, that you really look at this case. This case has a little bit of everything that can go wrong, and if you want it to go wrong and set it up that way, it's in this case. If you just take time to read the SEC complaint, it lays it out from A to Z, and what they're doing, don't do that. It's a pretty straightforward. I mean, it really is. For guys that are so smart, they obviously either had a greed problem, or they have OCD, or they're just control freaks because they wanted to control everything. run everything. They authorize every single transaction, every trade, every movement of money, every purchase. So they, obviously a control issue. That maybe that's why they wanted to do it. The whole Richard Nixon thing, where even though I'm winning, I still want to control everything. So they want to have all the information and take care of everything through the intermediaries. So, but this is a perfect case to watch on how not to do something. And if everybody, and this is part of your intent for the future, if somebody says you don't know how, they're going to bring up the fact that you said in this hearing and you were told that this is the way not to do it.
And the other thing I would say is, you know, when the public always thinks about the use of these offshore trusts and foreign corporations, we're automatically attuned to thinking tax, right? We're automatically attuned to thinking these individuals are setting up these foreign corporations, offshore trusts, for tax benefits. Well, keep your eyes open, because this is an example, whether it was their primary purpose or their secondary purpose, they were setting it up, at least in part, for something else, which is to commit securities fraud. So often we should tune ourselves into that as lawyers. There might be another goal here other than a pure tax goal.
To show you their control issues, when they had the securities spread out among these Cayman and Alaman trusts, they divided up the trust so that each trust would have less than 5% of a given company's securities. So in their head, they were thinking, even though I'm doing this tax evasion, money laundering, conspiracy scheme, they wanted to make sure that the trusts were not in violation and did not have to file the reporting requirement for having more than 5% ownership in these particular U.S. securities. So in their head, they think they're by complying with the 5% rule in the reporting, they didn't want the reporting requirement to happen, so they kept splitting and splitting and splitting trusts. Every time they bought new shares, they would say, oh, wait a second, I need to add another trust to make sure it's under 5%. So in their head, they're in such control of the issue that it's almost a reverse compliance. They're complying with the overseas trust in order to assist the evasion scheme. Amazing. Detailed and very controlled, but amazing. Smart guys.
So
I agree with you.
I will say this: I've been a defense lawyer for 20 years, and I constantly am amazed by that very observation. Because, but I think it's not that they're idiots; they're not. It's something else that you said within that description, which is greed and thinking that they're not going to get caught. Right? So those are the two things that drive it. There's a third factor that I often see in individuals that combines that, which is they start by operating in a gray area. They see that works, and they keep on going grayer and grayer until there's no more gray. Right? So if you look at, I think the best example is in this town is, even if you look at the Rothstein case, and you look at, I represented in the Rothstein case an individual named George Levin, who was the major feeder into Rothstein's Ponzi scheme. And just to give you an idea, without commenting on George's intellectual capabilities or anything like that, I'll just tell you this fact about him. When he met Scott Rothstein, he was 75 years old. He was worth $368 million. But yet he decided to invest every single was Scott Rawson. Okay? Now, look, he was never charged criminally. He never should have been charged criminally. But when you think about what he did, and you ask yourself why, for a reasonably intelligent man, towards, as he would say, the latter half of his life, to be, nice, to stake your entire wealth on this, something that seemed too good to be true, well, it's a little bit of greed, it's a little bit of blind optimism, and again, it's a little bit of, with these guys, we're above the law. We're buddies with the Bushes, right? We're buddies with the mayor. We're buddies with the governor. We're not hurting anyone. No one's going to catch us.
Mm-hmm. Yes.
But that, I agree with you.
That's the weakness.
But that is the dumbest thing of all, right? Because I don't care what they were giving him. When a federal agency knocks on a stockbroker, an attorney, a secretary's door, I don't care how loyal they are, they are going to flip, right? Now, when you do the type of work that I do, I will tell you, in the last 5 years, I've had 5 trials, and all 5 of those trials were based on supposedly loyal underlings who were now flipping on people that oftentimes they loved. And in fact, in many circumstances, when I'm cross-examining them at trial, the reason that makes them so powerful for the government is you can tell they still love them. And you can tell that they're hurt by having to testify against them. But given the choice of going to jail, losing your life savings, never seeing your family for 10 years, or flipping on the rich billionaire who they may love, who took care of them forever,
Let's go.
it's the easiest decision they will ever make. And the government knows it. The criminal prosecutions are made on purpose.
All right, that concludes our session on the Wyly brothers. You guys have a great day today.
Who's the better speaker, me or Joe?
You are, obviously. He's more robotic.
He's much smarter.
He's smart.